Okay, thank you very much. With that, we'd like to start our first geoeconomic dialogue. We have Vaidya moderating. Vaidya is a senior fellow with us on geoeconomic studies as well as a senior executive with the Mahindra Group. Over to you, Vaidya.
Greetings and good morning. Akshay, thank you so much for setting up this panel. It's always a tough task, right, when you have superstars in a previous panel, and then to come right after that with no time for people to reorientate themselves. Here is how this panel would flow, and I've had a chance to speak with the panelists about it, and I think they're fine. I'll take a few minutes to kind of set the context. The subject in question is about financial architecture. Is there something meaningful that countries like India can contribute to redesigning the financial architecture? Once I put out the framework, I will take specific questions to my panelists on their area of strength in the context of that framework, and then have a little conversation with them. But what would be really effective is if we have significant audience engagement through this process, because the subject in hand is about curating a new financial architecture. I don't think anyone here thinks that we can do it all by ourselves. So your inputs, your challenges, your feedback, your comments would be very welcome. So now that we've got the rules of the game out of the way, let me get started by saying that 2018, we are 20 years since the Asian financial crisis. The Asian financial crisis was explained that there were these countries which received excess dollars. They didn't know how to manage those excess dollars, created asset bubbles in their local economies, and these asset bubbles, when they burst, left a lot of people crying and left these economies in shatters. A bit self-serving explanation, because the solution that was put out by the very knowledgeable IMF and others was, thereafter, all you economies, do not keep your surplus dollars back into your country, keep them in the United States. That recipe served as a useful explanation for the next crisis that happened in the world 10 years thereafter in 2008, where the recipe was about excesses by the financial market players, lax regulation, supported by a cornucopia of liquidity in the system. And remember what I said? That liquidity in the system was created because all of these Asian countries, and China got added to that, left their excess dollars in America, created surplus liquidity. Money is the root of all evil. So we are 20 years after the Asian crisis, but that was not so much of a contagion. 10 years after the Lehman crisis, which Manjeet would always maintain that if it was Lehman Sisters, we would have never had a crisis. 10 years after the Lehman crisis, is the world better off? Are financial markets better off? Are there no bubbles out there that we need to worry about? Have we addressed the problem of excess liquidity in the system? Do we have enough faith that the regulators know how to track, hopefully prevent, but certainly come in and cure very quickly if there are aberrations, excesses in the system? That's the question in front of us. If I just take the first point, I would be challenged if I don't get a majority of people in this audience who don't agree with me that we are entering a bubble phase. Yesterday at the think tank T20 discussion, Anup Singh made the point that not only are we entering the excess debt phase, what is of major concern is that excess debt is accruing lower productivity. And that clearly sets the pace for the bubble phase. That's the backdrop of financial markets. If we talk financial market architecture, in my head, I have a quadrilateral. I don't want to give it definitive shapes like a rectangle, square, parallelogram, because I just know that there are 4 dimensions to it, there are 4 facets to it, each has its own weight and strength and direction. The first facet is financial stability. This is singularly beset, responsibility is beset with the government and central banks to ensure financial stability of economies. Gnawing at the seams, irritating the world, are 2 aspects affecting financial stability. One, within a country, we spoke about the excess debt, debt coming at lower productivity, and therefore debt manifests through what we like to call shadow banking, and therefore reaching levels which are alarming. So there are countries in the world where debt to GDP ratio is 250%, 300%, and so on. The second part of it is more international, which is the systemic risk aspect of it. And that comes out from 2 things. One, actions driven by central banks. We almost had a comparative quantitative easing phenomenon that there is still excess liquidity in the system. Currency management issues. The spillover effect coming from this kind of comparative quantitative easing that we've seen. So that's where financial stability sits. The second aspect of it is market integrity. Do we have faith in markets? Do we believe markets are in a fairly valued state? Are the regulators capable of overseeing the market to prevent another crisis that would spread violently? The third aspect of financial architecture deals with innovation. Innovation is welcome. Science and technology has taught us how useful innovation can be, but innovation could be double-edged. So underlying technologies such as big data, technologies such as blockchain, digital technologies do have tremendous value and add value to mankind. But it manifests in certain products and services which may not be all that healthy. For example, something like a Bitcoin. What does that do to financial markets? When we speak about digitization, it is important to contrast it with financialization of economies. While digitization entails the use of digital technologies, financialization of economies is when large chunks of the economies get influenced by financial markets. So there is not a product in the world today on which there is not a financial market surrogate. Take food crops, take cash crops, take oil, take any commodity, and there is a financial market. And these financial markets were supposed to dovetail the underlying commodity markets, but today the tail wags the dog. So sitting here, I would say that a new product I would put out is a conference futures product, and you can rest assured it will always run at a premium. The fourth leg or the fourth dimension to financial market architecture is market infrastructure. Do we have resilience in market infrastructure? Are the risk management practices that's adopted by different parts of the market contemporary and valid and effective? So these are the four dimensions: financial stability, market integrity, innovation, and market infrastructure. So that's the context that we have. Against this, our mandate is, can we create a new financial architecture? And you know about the panel we have. We're very privileged to have a former governor of a central bank, Dr. Zeti, from Malaysia. The question to you, you've been extremely optimistic in saying that we've learned from the Asian financial crisis, and Asia is a lot more resilient today than ever before. What is the source of that conviction? Share that with us.
Well, first of all, may I comment? Well, first of all, thank you for the invitation to participate in this magnificent event. You talk about the framework of the financial architecture, financial stability, innovation, market integrity, and the financial infrastructure. This is very, very important and necessary to have. But when we revisit finance and the role of finance, it's very important to look at finance not being, it's a means actually to an end. It's not an end in itself. And when it became an end in itself, that was when the problem started, because financialization made it grow bigger and bigger, and some economies it's larger than the size of the overall economy, and by many measures. And therefore, finance has to be a means to an end. And what do we mean by that? What we look at is that it needs to promote economic growth and development. It needs to contribute to the community, to society, add value, and it needs to contribute also ultimate goals being environmental sustainability and so on. So we need to look beyond these pillars into the ultimate goals of finance, into the role of finance. Now coming to Asia, yes, especially Southeast Asia, where we experienced the crises 20 years, exactly 20 years ago. And we have a high degree of confidence on our resilience and now, and we demonstrated our resilience during the crisis in the developed economies. Of course, we were affected by the spillover effects of that crisis, but we emerged to have growth quite quickly. Our financial systems in Southeast Asia in particular were never disrupted during that time. The credit flows continued and supported the economic growth. So what is it that is attributes to our resilience? What lessons did we learn and what did we do after the Asian financial crisis? We did everything that perhaps other parts of the world, especially in Europe and even the US, might do in order to not be vulnerable or at risk to future crises. The first thing we did was restructure our economies. We moved from being export-led to promoting domestic demand. We were investment-driven, and we moved to increase the importance of consumption. We reduced the role of government and was private sector driven, and we focused on the role of SMEs in the economy, and we diversified our economic structure. Like when oil prices plummeted, Malaysia is an oil producer, and we didn't have our economy plummet as well because we had diversified it. Then we transformed our financial sector, strengthening our intermediaries by restructuring, consolidation, and rationalization, building our financial markets, and in particular, moving from bank-centric system, which was a major risk, to developing our bond market significantly for private sector to raise funds for long-term investments. Financial reforms were deregulation, greater market orientation, greater efficiency, removal of restrictions, and liberalization so that we had a more competitive financial system. We also had a more flexible exchange rate regime, and this was important. So we strengthened surveillance. We transformed and strengthened our supervisory and regulatory regime. We built more inclusive financial system. We developed talent for the financial sector. We leveraged more on technology. We had the financial safety nets, deposit insurance, and increased greater transparency. But that was not all. We also addressed our vulnerabilities and rapid credit growth, rising indebtedness. We used macroprudential measures before they were called macroprudential measures. So G20, well, at least they announced that they first, when they used the word in 2010, macroprudential measures, they thought that it never had been introduced. But Asia had been using these measures in the 1990s already, and they're highly effective to prevent formation of property bubbles and reining in indebtedness. We also had a very important mechanism, and this is something that the US didn't do and many other countries didn't do. In Southeast Asia, we had mechanisms for debt restructuring, not only for large corporations, but also for households and small businesses. This when property, like in the subprime, there were many foreclosures and people lost their homes and so on. But in our case, we had mechanisms for restructuring these debt, and it prevented widespread foreclosures and bankruptcies. And of course, financial education and so on. Then my final point is regional integration. And just now, of course, when they talked, they only talked about the big powers in Asia, of China and India and Japan and so on. But I'm from Southeast Asia. Southeast Asia, when we had the crises, we managed it individually, but we realized there's tremendous benefit in coming together. We are 630 million people in Southeast Asia, and we represent quite an important global or economic power in the global economy. We have come together for example, we are so highly diverse, but we trade more with each other. 50% of our trade is with each other. So as our economies grow, we are less affected by the outside world when their economies are not doing so well. And then we have greater cross-border investment between each other. We even invest in China and amongst ourselves. Then a more recent phenomenon is the cross-border financial flows. And this is important. Our financial flows with each other are more stable. And the financial flows that you see, like when we put our surplus savings, we invest it in the developed financial markets. Then they come back to us in the terms of volatile capital flows. And but the stability of financial flows now, because we are surplus saving economies, we save in, or invest rather, in each other's countries, both in the financial markets as well as direct investment. Then we have increased connectivity of people flow, virtual connectivity arising from digitization. We heard stories of that yesterday. And then amongst the regulators, we cooperate. We have institutional arrangements of sharing information, surveillance, harmonization of rules and regulations and practices, sharing of experience. We have financial safety net, which is the second largest after Europe, 240 billion, and then capacity building and integration of our financial markets. So this is how we built our resilience, and it's already been demonstrated, and we believe that ongoing collaboration and cooperation between us, we will emerge quite a power to be reckoned with.
I think there's some fascinating comments. Strengthen individual economy, get like-minded such economies together to make them even stronger, which is ASEAN, united we stand. Reiterate first principle that finance is a means, not an end in itself. And I think these are important messages, or it should become part of the credo of building a financial architecture. You made a comment about the role of finance in trade. So therefore, I'm going to use that as a cue to go to David Rasquinha. David has a very difficult job in sitting in EXIM Bank. The product he deals in is part of the world of finance, which is globalized, and there is no way on earth anything can do to deglobalize it. But the product is targeted at a business, which is trade, that is seeing protectionism, that is seeing deglobalization. And entities such as EXIM Bank exist to contribute to the real economy by providing credit to the SME segment so that they can be export competitive and create jobs. And that's how they contribute. So if I look at it, he's got two lines, one going in a direction of continued globalization and the other kind of facing some headwinds to globalization and protectionism. And between these parallel bars, he has to do his gymnastics. How do you do that? And what do you see are the challenges, and therefore what implications to the real economy?
I think I'm a little too old for gymnastics, but let me try how that works out. 2 points on that, Vaidhi. First, on the general issue of protectionism, yes, this is a worry. The point came out yesterday when we were having one of the panel discussions that from the time of Adam Smith onwards, you've had a consensus globally, intellectually, economically, governmentally, that trade is an unambiguous good. There will be winners, there will be losers, but the number of winners and the quantum of the win will outweigh the number of losers and the quantum of the loss. For probably the first time in recorded history, you're having that consensus now being questioned. And questioned not just politically, but you are seeing this question being raised economically as well, which is a bit of a surprise to many of us who came up in this era. What is the answer to that? I really don't know. Is it just a momentary political phenomenon which has been driven by electoral means, or does it have greater implications? The existence of a dominant player like China in manufacturing complicates that further, because you are having legitimate questions being raised about market economy status and the sheer size of the problem. So I acknowledge that there is a problem. Very honestly, I do not know what is the solution to that. I guess we have to kind of feel our way as we go forward. On the second part of your question, I think it's more an issue of risk. For an EXIM bank, if you look at any country in the world, typically the vast majority of trade, the export basket, goes through the commercial banking system, which is as it should be. An EXIM bank is in many ways a lender of last resort. It is supposed to address those transactions that are too high risk. A difficult country, a very long credit period, a complex transaction, a capital intensive good, which a commercial bank is unwilling or unable to finance, which is a vanishingly small percentage of a country's economic export basket, but a component that has to be built up if an economy is to move up market. When you're talking this, you're talking long credit periods, then you're basically talking risk assessment. Now here the dichotomy arises is that evaluating risk or appraising risk per se is not a problem. There is information available, there is market recourse available, which enables you to appraise that risk. The challenge lies in pricing that risk. Historically, a buyer of protection hates to pay a risk premium. And typically with an Indian exporter, which is the constituency we deal with, as well as overseas importers, there is a reluctance to accept pricing of risk. Typically, the tendency tends to be that, look, you're looking at a situation which may never happen, but that's what risk is all about. That is what risk modeling is all about. So my challenge, I would say, is not so much in evaluating that risk, but how do I price that risk accurately to defend my balance sheet and yet make a product which makes sense for the buyer?
That's the, I need to come back to you, but I will let you collect your thoughts on that, because you made it sound simple that the risk assessment is possible. I worry about how do we do country risk assessment. 3 years ago, I would have had a certain country risk assessment about Sri Lanka based on what was the data available then. And over the last 2 years, with the amount of data that's come out on Sri Lankan macro indebtedness, I may have a very different assessment. And you are doing credit assessment at 2 levels. So let me park that for the moment, but I do want you to think about, because we need to come back to that. But the second part of his comment, which takes me to Eric, and before I share that comment, in Eric, we have somebody very special. Maybe give him a round of applause and I'll tell you why. There are very few people I know, including myself, who will walk away from a prize of, say, $8 to $10 million. Eric is one of those noble souls who told the SEC, I am not taking your money for being the whistleblower. And he and his colleague were entitled to $16 million. Maybe in the break he can tell you further. I like that. Make that sound louder, please. Maybe in the break he can tell you his soul constitution, the makeup of it that made him walk away. But please don't tell my wife that. I'm going to come back to the comment he made. Is the challenge he has is in pricing risk. And all of us from financial markets take pride in the fact that markets understand how to price risk. So David is not part of the market, but he uses the market, he faces the market. Eric was part of the market, I was part of the market, and we pride ourselves in saying markets understand how to price risk. So if I bring that into my framework on market integrity, the challenge with the market today is what started as derivatives, the tail wags the dog, has acquired a shape and size of its own. So if I look at the last 12 years, oil has seen 3 spikes to $140+ and 3 troughs to $35, $40. The demand-supply situation has not moved that much. So supply disruptions have been never in the region of more than 5 to 6%. But you've had a 3x up-down movement 3 times in that. A kind of standard deviation that would keep even a dead man alive. The question for you is, if market integrity is an integral part of financial architecture, how do we bring that to bear so that people like David know how to price risk? Are you comfortable with it? And then I have a follow-up on that, is, are the regulators doing enough to come up with effective circuit breakers and speed breakers to control markets or regulate markets when they go out of whack?
So first of all, thank you for the kind words, and I'm very honored and grateful for being on this panel. I would say my answer to a lot of things, I'm kind of like a broken record, is that many of the things, many of the problems that you see are symptoms of deeper problems. The 2 problems that I've encountered during my ordeal as a whistleblower were really the independence of gatekeepers on the one hand, and the incentives. Can everybody hear me? The incentives to the people who are actually the risk takers, whether it's within the banks, the salespeople and traders, or within the larger corporate picture, the executives. And I think the answer I've encountered is no, at least partially no. So I've encountered gatekeepers that were, in many cases, co-opted. And I've encountered incentive structures that are skewed in favor of risk-taking, where the risk takers get to keep the upside and they get to socialize, if you will, the downside. I think that has not, for the most part, that has not been fixed, at least where I've been following. In the US, On the Israeli side, I live in Israel now, the picture is more mixed. So you do see gatekeepers that, I think you might see that in the news, are actually very aggressive and independent. I'm not quite sure yet how that happened. It looks a little bit like a miracle. But I think ultimately the market volatility that you see in many cases is a symptom, is a downstream symptom, several layers removed of that phenomenon. And I think that, and you mentioned that we might be in bubble times now and the misuse of debt. I think debt is the rocket fuel that if you add that to these two issues, could really make a small problem huge. And I think that's where we might be now.
Okay. So I guess what you wanted to say, didn't say, is profits are private and losses are public. And that was his guiding principle when he refused the principle that was offered to him on grounds of principle. How do we therefore, in a market like this, align market participants' interests? Because markets work, market participants work on the overarching urge, greed. Now you go and tell them that you need to have risk management, you need to have gatekeepers, you need to have them independent. They're not going to listen. So how do you align regulatory measures to induce the right behavior?
So I actually think that we don't need more regulations. If anything, we need less. But I do think that we need to I think the key is having, the only word I know from finance is Chinese wall for this. So a Chinese wall between gatekeepers inside the corporation and, of course, at the country level, at the state outside the corporation. And those, I'm afraid, what I've seen are not really in place. The other issue of sort of aligning incentives, I think, we saw in the U.S. Dodd-Frank was an attempt to change that. So, for example, having clawbacks from executives, or the Volcker rule, which was to limit how much risk they could take on a proprietary basis in the financial institution. But it hasn't really solved many of the things that were outside of the financial sector. To a large extent, I think the regulations were already in place after Enron. So I think Sarbanes-Oxley should have been sufficient to prevent this. I think the real problem was that the corporate structure has not been reformed after Enron. So we still have corporate structures where the CEO and the board are too friendly, and they have complete control over, the audit committee isn't independent enough, and so you have a breakdown in many cases of the protection for other stakeholders, including in particular bondholders, who oftentimes end up paying the bill, and the bondholders oftentimes are pension funds, and so this is one way to socialize losses. So I think if you fix that, and it's not trivial. I think changing how making the corporate structure more democratic in a sense, or at least changing the incentives, is not so easy. I don't think clawbacks are enough. I don't think the Volcker rule is enough. I think a more fundamental change is needed. I actually think that some of the new fintech technologies aim to do that. So I think you mentioned Bitcoin. I think there are a lot of people who want to democratize the financial system and more generally the economy, and I speak to many of them in my new role as a consultant. Their dream is to make finance and the economy more democratic and to change how the corporation works. But I think we haven't cracked that yet. So I don't have a good answer in terms of how to fix the incentive structure. I do think that limiting the amount of leverage, the amount of debt that corporations can take on, large corporations, would be a big step towards limiting how much damage the skewed payoffs would cause. And and I think it's very important that you raised fintech, because my hope is that that's where ultimately our cure to some of these illnesses would come from.
We will come to that. We may have a strong debate on fintech and its effectiveness. But before I get to that, I want to put on the subject of risk and risk management, and I want to come to you, Claude. Whenever there is a market issue, for example, and we go to the wise men who sit in exalted towers who would give solutions. So one of the solutions propounded after the 2008 financial crisis was pinned down that we need to have less of over-the-counter products, more of centrally cleared products. So systemic risk is not limited to systemic risk affecting financial institutions, but there is systemic risk caused by financial market infrastructure, financial market utilities. Now, all of us, for example, in India, while banking clearing is settled through central bank funds, the stock market clearing is settled through a private entity called the National Stock Market Clearing System, through which bulk of the clearing. And there are such market utilities across. Help us understand, A, what the risks are coming from market infrastructure utilities that can affect financial stability, and B, what can reasonably be done to ensure that we mitigate these risks?
Well, is it working? Yes, it's working. Okay. So first of all, thank you for inviting me and being here. Regarding financial infrastructure, I think Basel III actually it's one of the things that among the macroprudential or solutions that they provided to ensure that the financial system, to enhance the resilience of the financial system. One was, as you said, focusing on CFIs, and the other one was to make sure that a lot of standardized over-the-counter derivative contracts were cleared in a centralized manner via clearing houses. However, when you do that, what you end up seeing is from a risk that was, covered by just bilateral transaction, now is being accumulated in that hub. And so that hub suddenly becomes something that we just talked about, which is a CFI by themselves again. And so in that case, what has to be... Sorry. So what has to be done, or the roadmap that has been given by Basel III and Dodd-Frank, is to once, at least if you have the risk in one place, it may be easier to monitor and to have an idea of what's going on. And so because the CCP become a CFI, what you need to make sure is you need to do the stress testing that you do for every large financial institution to make sure that you have an idea of how resilient they are. And once you have that, you also need to come up with a way of dealing with them. Is there where to fail, of course, because the concept of centralizing all those trade in this clearinghouse is to make sure that things will continue to function, even if there is a shock. Except that here we're not talking about a shock, we're talking about a shock to the entire system. And that's where we then having an issue with what has been implemented so far in the monitoring, which is all the assessment of the resilience of those big hubs rely on the failure of one of the members. Those members are usually banks, they're usually CFIs. So you see how now we're having this accumulation of the risk, which is, well, those CFIs are also in charge of providing liquidity elsewhere in the system. They will be under duress if there is a systemic shock. If there is a systemic crisis, you may expect that there is more than one in duress. Then you see that most of those big banks are actually members of several CCPs. So I think we understand that it becomes a very complex issue, and at one point, what then the regulator should be deciding is, when do you draw the line? That means, what is a priority? Is your priority to make sure that the system continues to function? And that's very much what we saw with the crisis, that without a functioning financial system, government and central bank can do whatever they try, it doesn't work. And it should be a priority. And so to do that, you need to have a backstop. Whether you want to make sure that you will provide, liquidity to CCP no matter what, or to their bank member, they need to be a decision that has to be made. And this is still a work in progress, of course. So, because this dimension of the macro aspect of the risk, so far, whenever it comes to CCPs, has been forgotten. And I'm only talking about CCPs because that's pretty much that far that the regulation went. All the international payments, which are also fundamental issues, there is very little discussion regarding really doing anything.
Sorry to intervene. When you talked about that there has to be a backstop and that has to be, and I'm nervous about that. And I'll tell you why I'm nervous about backstop being with regulators. In the middle of the 2008 crisis, it was almost a coordinated effort across all regulators to ban short sales. There were 3 exceptions to it. 3 markets were exceptions to it: Hong Kong, Singapore, and India. So my worry is when you have a backstop sitting with an authority which can also bring in collateral measures such as these, which are counterintuitive to people who believe in Puritan markets like me. How would that work? Wouldn't there be a simpler mechanism to simply say this would get settled with central bank funds? The second, you also made the point about banks having dual things. So Ben referred to the Walker rule. Therefore, do we need to bring Chinese walls to banks playing roles which straddle both commercial activity and infrastructure activity?
2 very good questions. For the backstop, I know it's a theoretical concept. Or do you make it happen? That means you need to know in real time when to make the decision, which I agree with Eric. I think that technology will, is already on its way, but it helps us to have a better understanding of what's happening in the market. And that will allow us to make the market more transparent and things like that. All those things are essential because to be able to make a decision, you need to be able to monitor efficiently. Gathering data is great, but you need to know what to do with it. I mean, all those things, so it's really not simple. That's one. And the other question, I'm sorry, I forgot.
Banks doing conflicting activities.
Yeah, well, so there's 2 sides of the story.
Purportedly conflicting.
Yeah.
I don't want bankers here to
No.
throw darts at me.
I mean, on one hand, I understand that we would all love to have this very simple banking system that just do the old-fashioned way of doing banks. Fine. We understand that the world is not there anymore. That we actually, those banks, they actually, and we talked about that yesterday regarding the payment system, they can be a great tool to really developing a network and providing funding in places where there is no other institution available. So, yeah, what we need to do is have a better understanding of how things work. And so I'm not sure it's easy to go back. I mean, you see that with the Walker rule, we're rolling it back. Banks are also there to generate a profit. So maybe it's a question of incentive to do the right thing. Maybe it's a question of making sure we have a better understanding of what's going on. That's been a lot of interaction between regulators, technology providers that will tell you what the instrument of tomorrow is going to be whenever you're designing those regulations. Because I agree also with Eric, I don't think we need more regulation, but we need better one. And I think pretty much everybody agree with that one.
I think the next time I would present the framework, I would make it a 5-sided figure. And I like the point she made that complexity is irreversible. So don't look for simplistic solutions like Walker rule because we can't reset the clock, but use technology to better manage looking ahead. And I think that's a very important one. I hope Akshay has made note of that. Kiran, coming over to you. SWIFT is a bit like God, right? We all know it exists. Nobody has seen it. Nobody has felt it. But it's an important mechanism running behind the scenes which connects banks across the world, and transaction values over hundreds of billions of dollars go through it every day. Or maybe the number is much more than that. 2 things, Kiran. One is, since Ben referred to Walker, Paul Walker made a very interesting comment. He said the last useful innovation in finance was the ATM machine. SWIFT predates that, so I don't think he had you in mind. But the second part is technology that's coming in. How is SWIFT embracing technology to focus on operating risk management and better transparency on know your customer? So these are two questions I have for you.
Thanks, Vaidi. Can you hear me? It's really a privilege for me to be here. Can't hear me? So I was saying, Vaidi, it's a privilege for me to be here. Good morning to all of you. So just a clarity on the volume that we carry each day on our system, since you referred to it. Every third day, the world GDP flows on the SWIFT system, just as a number. And we take that with great sense of responsibility towards the entire world economic geography, right? So from our perspective, we constantly look for innovation. So we have a SWIFT lab that we've created where we invite folks from various walks to come in and use our relevant technologies to figure out how they can further bring enhancements to it. And that's an ongoing process. We also have a tribe where we fund startups to evolve and bring new technologies to marketplace. And that has been a conscious effort on behalf of SWIFT since we operate in over 200 countries and territories. In terms of risk, over the last few years, we've seen increasing risk over cyber. And as part of that, we've come out with a customer security program where we have shared 16 guiding principles that will help banks prevent cyber fraud in their environment. And to the extent that we have gone and started to audit each of those principles in select sample groups and review them, we keep guiding the regulators and others on what we see in a specific market. So essentially, I'm saying two things. One, we work very closely in terms of evolving innovation and continue to sponsor and bring them up to speed and try to embrace them as they progress. The second is that we work very closely with the regulators and the government agencies to share best practices. These days it's around cyber security, but any other as they evolve. So that's how we focus. Did I answer all your questions?
From an operating risk standpoint, how do you use technology? For example, if I take the recent event, which it's too simplistic to say it was because SWIFT and the underlying banking system were not connected. I grew up in my early days in banking, in operations, so it was too simplistic an explanation. But one of the solutions over long term talked about, and you mentioned about innovation, is using technologies, big data analytics. So for example, if I look at the credit card industry, a credit card industry sends you an alert if there is a suspicious transaction before you can say Sri Ramajayam or Alleluia, depending on your ideology. And that's how fast they respond. However, in the interbank, where, as you rightly said, every third day the entire GDP is getting turned over, how much is that technology in play to make it idiot-proof, proof from people like Vaidi?
So if you're referring to the recent fraud that we've seen here, it's unprecedented in history or anywhere else in the world.
Just give a one, because there are a lot of people who may not know. Just give a 2-3 sentence explanation of the story.
So we witnessed a fraud in India recently where there were guarantees issued by a bank without any underlying collateral behind it, and that has been going on for over 7 years. I think it's a very difficult thing to comment on because no technology can help this kind of a fraud where passwords have been shared between maker and checker. The audits have failed to catch the trail in 7 years. I think it's not about technology. I go back to some of the fundamentals that Richard was alluding to in the earlier discussion that we were having. As the world is evolving, India has accelerated on a digital path at a very fast pace. We also need to evolve and graduate the skills and education around financial hygiene in the country. And I think that is a very important element. And that's how I would put that, Vaidi.
So we want to come back to when would we see market infrastructure, utilities like yourselves, use technologies like big data, which kind of become agnostic to the operators? I just look at trends. If I see something out of whack, like a MasterCard, send an alert.
So we already are doing that. So like, for example, if a bank operates between 9 to 5 and they put a control to say the payment can only go between 9 and 5, those controls are in place. There are a lot of validation reports, data checks that are there. It goes back to the usage of that information and data, which I'm saying is missing. Okay. So a lot of those pieces are available, but they're not being used.
I want to come back to Dr. Zeti. We spoke about one way to address this is A, become strong, and B, partner with us, like-minded countries, and therefore you become stronger. I want to take you to a real problem we have. The world is still not in a consistent growth phase. Across central banks in the world, the reserves built up, which again, the wise men of IMF said the best way to address systemic risk is you build reserves. So countries are competing, and today the total reserves held is something like $11 to $12 trillion across the world by different countries. India, for example, has $400 billion of reserves. Now, this is obviously a very unproductive allocation of capital. Bilaterally, countries can do things like currency swaps, which can put in place some mechanism that I draw on. ASEAN has come up with this Chiang Mai initiative where you have a block of countries kind of say that we will help you in terms of crisis. Can we raise the bar? And the reason I say that, and David spoke about we need to work for growth. Assume for a moment India did not have 400 billion and decided to live with just half that number, 200 billion. And that 200 billion was invested productively, and if it delivered the same return as return on savings, India's GDP can go up 100 basis points, 1 percentage point, and that growth is significant. So is there a better way for the world to come together, G20, central banks, IMF, to come together to say, hey, don't lock up unproductive capital in reserves. We are there. Put this money in productive use in your respective economies. Would that be a better solution?
Well, let me just put it this way, that yes, there's cost in holding reserves, but the reserves are an important buffer. And the cost of a crisis would be far more than the cost of holding reserves. For example, in a country like Thailand, the cost of the crisis was 30% of GDP. In Korea, for example, which is a developed country that was significantly set back during the Asian financial crisis, they are still paying off the cost of the crisis in terms of they issued bonds for restructuring of their financial sector. But as these bonds mature, they rolled it over. So, like, future generation is going to pay for the cost of this crisis. So, the cost of holding these reserves is a fraction of the cost of the crises. So, but the world is far more complex than that. When we undertake surveillance on capital flows, we look at what is the nature of these flows. There are those flows that are of a permanent nature, that they come into your country and they invest in your pension funds and investment corporations and so on. But there are those capital flows that are of a very temporary nature and speculative in nature. Because we have achieved near-time, real-time information on the nature of these flows, we know what comes in and that could move out very quickly. What percentage in terms of our national risk management at different, for example, levels of the stock market and so on, if they liquidate and have massive sell-off, what is the amount that would be flowing out of the country and would depress the exchange rate, would come crashing down and lead to loss in confidence and so on. Let me give you an example of Korea again, when the taper tantrum hint that the taper tantrum was going to happen in, I think, May of 2013, that there was massive inflow. And before that, outflow. And before that, we had all experienced massive inflow. And we saw the Korean won, because they didn't intervene in the market, appreciate by about 30%, about 35%. Then when the hint of the taper tantrum happened, there was a massive outflow, and the exchange rate came down in Korea by about 38%. Now, if a country, of course, Korea has trade as a percentage of GDP about 70%, but for a country like my own country, where it's almost 200%, and you have your exchange rate go from one extreme to another, appreciating first of all by 30% and within a few months depreciating by such a significant percentage, it will create instability, disrupt trade, and be highly lead to loss in confidence, and probably in some countries sentiment would drive it further, and you have what textbooks describe as overshooting in the foreign exchange market. Now, because of all this, we want to have the buffers to deal with these kind of temporary capital flows that come in and out of our country. We want to be able to not allow or to have orderly market conditions and not allow this highly disruptive and destabilizing factors to affect the functioning of our financial markets and economy. Thank you.
I want to come back to David. You spoke about risks. Country risk assessment. What would be the benchmarks you would say that countries have to share with transparently, so that, because every country is connected to the rest of the world, so that you have a better strike at good quality credit risk assessment?
Here one needs to look at two sets of countries. Typically for an EXIM bank, you're not really focused on the developed world, because your cost of capital in a developing economy is much more than the cost of capital in a developed economy. So you're fundamentally focused on those countries which are necessarily rated below yourself or on par with yourself, because these are the countries which are your effective universe for selling your exports. The challenge here then is one step before risk evaluation, and that is data availability. How does one get data? How does one get reliable data? There are countries where the statistical system is frankly far from developed. And getting data means you're then relying on secondary sources. And if I may be a little bit facetious, I think sometimes an actual visit, kicking the tires on the ground, gives you a much better feeling than going through the available data, because the data is simply not reliable. There are countries also, and I think we know who those countries are, where the data is deliberately managed. You have GDP estimates coming out on the first day of the next quarter. You've had countries where the IMF has pulled them up for deliberately falsifying statistics. So these are challenges which come up. But I'd like to come back to the point you made, Vaidya, a little earlier, which is part and parcel of this question. And you made an assumption that the markets are pricing risk. Are they? I honestly have my doubts. I could point to the stock exchange right here in the city we are sitting in as a brilliant example of mispricing risk, but that's jokes apart. Look at any market which is evaluating and pricing risk, be it the stock market, be it the forex market, the credit market, be it even the credit rating agencies and the symbols they are giving. I honestly have significant doubts whether risk is being priced, and this is for two reasons. One is we tend to have a cookie cutter approach. Once an agency, be it a rating agency, be it a bank, be it an investment agency, has developed a certain set of parameters based on which they evaluate risk, they apply that set of parameters universally to all countries. Now, this is fundamentally a fallacy. If you look at India, for example, the rating agencies harp about the fiscal deficit. The fiscal deficit for India is irrelevant except to the point that it crowds out private investment. What matters for India is the revenue deficit. Unlike countries in our neighborhood, Sri Lanka, Indonesia, which rely on foreign borrowing to finance the fiscal deficit, or for that matter, Europe, India does not rely on foreign borrowing to fund the fiscal deficit. So when you are allocating a credit rating symbol and basing it significantly on the fiscal deficit, I'm sorry, that makes absolutely no sense to me. Now, this is just one example of what I mean by the cookie cutter approach. But more to the point, we have this childlike fascination and maybe even a love for mathematical models. Nassim Taleb pointed this out, and the black swan was just one example of this, but we have this childlike trust that a model can be used to represent risk. No, I'm sorry. A model is a representation of reality at a point in time based on a set of assumptions. It is not reality. We've seen that lesson come back to bite us in the face or other parts of the body at various points in time over the past, but we never really seem to learn that lesson. So I'm coming back to the point that you made and saying that no, the markets or the agencies are not pricing risk.
That's a subject by itself for another conference. So I'm going to come back, but taking the question of risks and markets not pricing, I'm going to come back to Eric. Eric, you made the point about profits are private, losses are public, CEOs are too close to the board, the corporate structure needs to be. I applaud you for being a higher order, more evolved person who said no to the whistleblower money, because you felt that regulators were wrongly penalizing shareholders who had nothing to do with the fraud, and it should have been coughed up by the people. I actually have a peeve against the US regulators and government. Since the financial crisis had global ramification. But the fines collected, which was over $100 billion, almost over $200 billion by the US Fed agencies, were kept by the US. They were not shared with the rest of the world. I personally think it should have been shared with the rest of the world because everybody paid for it. Coming back, so what would you say would be the mechanism to bring those checks and balances, A, within the organization, which is the gatekeepers versus the risk takers, and B, between the executive and the board? How would we bring this? How do we tighten this? And that's something that we could recommend as an outcome of this in financial architecture.
I just want to mention that this question actually ties, I think, very closely to the point that he raised regarding the mispricing of risk. I think the risk is mispriced to a large extent because much of this money does flow through the corporate structure, whether it's corporate bonds, and I believe non-financial corporate debt has doubled just in the last few years. And ultimately that finds its way into the stock market, into mispricing risk. So I think fixing this issue of incentives and gatekeeping within the organization would have an impact on also on the pricing of risk. So the solution to this is not simple because reforming the corporate structure requires a deep reform to how Western economies work. And I think that change has to come from regulators outside. The investing public, I'm afraid, doesn't have the power. They're too disparate. They don't have the direct leverage on the corporates to do this. So I think this ought to come from regulators. Unfortunately, the regulators themselves are not sufficiently walled off currently. So we're in a situation where we have to lift ourselves by the bootstraps. And right now, my approach is that I'm trying to spread the word and hope that it comes up in a grassroots fashion. But I think without some change in the mechanisms that would change how the gears work and give more power to the general investing public, that's not going to happen.
Let me push my luck a little more.
Yes.
You said that regulators themselves may have certain challenges and may be vulnerable. So the revolving door, there is a business case to make around a revolving door because you need market insights, expertise to come into the regulator's office. So is a way to address by saying that the cooling off period should be 3 years.
Yeah, I think that would be a solution, a partial solution. So I think really having cool-off periods would be significant. And I think it becomes an issue that is country by country, how the law enforcement structures are in place. So Israel is very different from the US there, for example, and I'm sure India is different from both of them. I think in the US case, it's an especially difficult situation because really there are so many opportunities for money to flow into the law enforcement system, whether it's into regulators such as the SEC and the revolving door, judicial elections, the way federal judges are appointed. All these things are to a large extent, in my opinion, broken. So fixing that is a massive task. So I think really there's not one solution for all countries here.
Majid, you should have made Ben set the business case before the world in disarray discussion. So he says there are so many broken parts. What are you looking for a silver bullet solution? I'm going to pause here. I think do you want to add something quickly before we take to the audience? Yeah.
Yes, very quickly. No one has mentioned the issue about ethics and values. And this...
Talking finance.
Yes. Yes, because there's a culture that needs to be developed on accountability and responsibility. Of course, the incentives, but also to develop the professional codes and then create the boundaries of responsibility and accountability and transparency. So all this earlier, it was the breakdown of values and ethics, really, that contribute to this. And therefore, over and above pricing the risk and so on, there's this component that's also, I believe, very important.
Dr. Zeti, how? Akshay wants us to come back with suggestions, takeaways. So how will I bring in, what would you recommend that countries do, or financial markets in respective countries do, to bring in these value systems?
Yes. Well, right now, we are looking at areas of responsible finance, and without taking a lot of time, there's ethical finance, there's Islamic finance that have brought in these kinds of where it's incorporated. If you're not going to add value to the economy, to the community, to the environment, and there are measures of all this. And then we've set up like professional boards that create these code of conduct. And then they have to be socialized throughout the industry. And then there's education of the board so that the board represents an important oversight on what is going on for us, the financial institutions, but more broadly to the corporate sector and so on. So all these are very important. And then, of course, everyone's spoken about the incentives that to have longer-term orientation rather than relying on short-term, so you can spread out your return over many years rather than the immediate term, and everyone focus on short-termism in trying to get ahead. Yes.
Long term for a lot of traders is end of day. I'm going to pause here and take questions. Sir, I think she's moderating the Q&A. Purvaja, standing there, is moderating. So if you have questions, send in your chits to her.
Okay. My first question is to anyone on the panel. Some have argued that the succession of crises is rooted in the global monetary system. Should emerging markets use the G20 to seek a new Bretton Woods monetary conference?
If I can request the former governor to take that question.
This relates to the issue of legitimacy, and there's been a great deal of advocate for the restructuring of the international organizations. And of course, G20 is a step forward because it moved from a G7 to G20. But the point that I made earlier, smaller countries, such as those from Southeast Asia, we don't really have a voice in this. And therefore, there's the how the world operates is based on through the lens of large economies and mostly the developed economies. And therefore, it doesn't take into account, and it relies on ideologies that took the world forward in decades before. And now, because of all the changes that have taken, the reforms of these international architecture of the multilateral organizations and their role in the global financial system and economy have not kept up with are not commensurate with the developments that have taken place. And they are far behind, really behind the curve. And now you have cyber crime and in the whole cyberspace. So the world is evolving so rapidly, and these institutions are becoming less and less relevant. And so what we have done, certainly in Southeast Asia and East Asia, we've relied on our own approach. And of course, when we talk of, there was talk during the Asian crisis of having an Asian monetary system that was shot down quite quickly. And so while they don't want us to try to manage ourselves, they also need to move ahead much faster.
I would add to that, Purvaja, two things I would push for. One, non-US, non-Europe G20 members should just put their foot down on non-transparent investment structures. Wearing the hat of anti-terrorist funding, wearing the hat of anti-money laundering, wearing the hat of know your customer inside out, no tax haven shopping. Just put your foot down to any non-transparent investment structures. We need to know the end beneficial owner. I think that's number one, and it should be a non-negotiable. The second is press for full disclosure if there is an issue. For example, I think it was in May 2011 when, for a short period, stocks corrected violently. There were some stocks which became $1. And, you know, the challenge with 24/7 television is you try to explain everything with sex appeal. So this was attributed to fat finger failure, 3F. Fat finger failure. So somebody, instead of pressing one key, the fat finger pressed two keys and therefore it triggered. My daughter, she's 12 today, will not buy that argument. So I think that's the second thing, that whenever there is a financial market disruption, we need to know the truth, and there should be only one truth. I think those two I would push for.
I think eventually we're going to get there. Right now, with the disclosure of all emails and information and financial data, we are getting there. There will come a point in the future where there will be full information on all these kind of activities.
Great. The next one.
So, given the interconnected nature of financial markets and the limited transparency in the financial system of China, is it a matter of time before we run into the next crisis?
Let me request David to take that question.
Ouch. I was afraid you'd say that. Okay, within the parameters of the room, I think it's a worry. If you look at China, and I don't claim to be an expert on China, so take this as an amateur response within my limitations. There are definitely worries about the shadow banking system in China, which has reached large proportions. Banking as a share of GDP in China is perhaps more than 250%, which is over what is considered to be a risk threshold normally. The shadow banking system is over and above that. There is a lack of clarity on what exactly is the extent of the shadow banking system. So you have a bit of a black hole over there. Add in the fact that the official reported NPAs in China are about 1.85%, and I don't think you'll find many people in the financial world who buy that number. So I think there is grounds to worry, but how much to worry and will it lead to, I mean, the rest of the question, I'm not even going to try to answer that.
I'm going to ask Claude to come in, not so much specific to China, but as someone who understands stability, risk management, if you have to look at countries which have these kind of financial markets in countries, what would be 3 or 4 things you would say? Please get to the bottom of this, or these are telltale signs there is trouble brewing.
Very good question. So a few things, so let's see. First of all, it's very nice to look at financial stability, and we have all those macroprudential tools, but we realize that they are really efficient when you have the monetary policy, which is the correct one, and the fiscal policy, which is the correct one. So my question is, what are the US doing? So, so that's the thing. So, okay, so whenever you look at financial stability, there is no magic tool. You need to have the right tool for the right thing. Thinking that macroprudential is going to allow you to balance or rebalance the instability that you may end up inducing by normalizing the monetary policy is one thing to look at. I think everybody also, yesterday we had a discussion regarding the level of debt and what will this increase in interest rate in the US will trigger elsewhere. So that's the thing. The other thing is, it's really nice to talk about harmonization and G20, but I think that G20 was a very efficient place to discuss when all the countries had the same goals. Everything was aligned. I'm not sure we're in that case anymore. I mean, we all go back to, our own growth, and keep in mind that macroprudential policies are supposed to be really, really refined tools that suit the needs of your country. Same thing with monetary policy. I mean, it's domestic driven, it's not internationally driven, so. Plus Europe, I mean, there's a lot of question mark on Europe also. I mean, the Brexit and things like that. So, yeah, I'm not sure I'm answering your question. I'm just saying that it's not only China as a risk, there's a bunch of risk everywhere, and it's a combination of all that will or will not trigger the next crisis.
But I like the way you very subtly said that the rest of the world has some levers that it can tighten and squeeze China. The subtle reference, well taken. Yeah, Puruja, one more, and that'll be our last question.
This question is for Mr. Shetty. How will the financial world respond to the threat that comes from the dark web and bitcoins?
I think I can talk about the cyber piece. I think there is enough and more knowledge that is available. It's about incorporating those knowledge and executing them at your respective environments. We have been working very closely with the banking community and the financial community in sharing insights, information that we gather from across the globe. And they are really a step ahead. I believe that the only solution to cybercrime is to stay ahead of the game, one step ahead each time. And these will continue to evolve. What we prescribe today may not be what will be relevant tomorrow. And that's the evolution of the journey that will continue to happen in that space. That's what
Purvaja, if you could pose the question back to the person who said, can that person tell me whether Bitcoin is a currency or a commodity? But we'll take that up later. Thank you so much. We're almost hitting the end. So I just wanted to quickly, first before I summarize, I wanted to ask if anyone wants to make a closing comment. Okay, good. So we can just, this is for Mr. Mathur's benefit. Where is he? Akshay Mathur. Our recommendations from this group for a more robust, stable, strong financial architecture. One, finances, the principle should be finance is a means and not an end, and therefore focus on the economy, liberalizing the economy, and build macro-prudential regulations. So that's the first one. The second, focus on resilience, build reserves, and align with like-minded countries. The third, pricing in risks. It is a challenge, but come up with a system, recognize the fact that what you see may not be true, come to terms with it, be more discerning, but price in risk to cover not just the counterparty, but the country as well. 4, go back to principles of Chinese walls, which were in the Glass-Steagall. By the way, I must mention, the Glass-Steagall, which lasted for some 60 odd years, was a 32-page document. Everybody understood it very well. Dodd-Frank is about 600-700 pages plus 3,000 pages of annexures. I don't know of anyone who's actually read it cover to cover. Right? So the point he made that regulations are big, you don't need more regulations, you need regulations to be implemented. So going back to Chinese walls, that was the recommendation. Go focus on Chinese walls at 2 levels. One, between risk compliance and the trading function. And the second, I guess Ben, being so young, is prone to idealism. He said there has to be a grassroots-driven revolution to reform corporate structure. Dr. Zeti and I don't have that kind of patience. So tighten the rules around regulators, revolving door, and professional boards. I really like the idea. Bring in professional boards. Then the point about systemic risk, build backstops, but don't make it fuzzy because you don't know how the regulators will behave during crisis. So have pre-agreed backstops who will do what. Operating risk, including cyber risk, is a major area of challenge. And then focus on higher order things. One is financial hygiene education, and the second is ethics and values. So we started with the honorable things at the real economy. We are ending with honorable things relating to the soul, and in between the markets exist, and we have hopefully solved the problems there. Thank you so much for your patience. Thank you so much.